Welcome to today's episode of Informed Investor. Today, we will talk about something that's been making headlines in the financial world: India's rising weightage in the MSCI Index. Now, we will delve into the significance of this, explaining its impact on the stock market. The inflation topic has taken a huge space in financial discourse, and India recently released its inflation data for the month of January. Let's dive into what's been happening with India's retail inflation and break down how recent changes in inflation rates might influence RBI's decision on interest rates. Now, we will also chat about something that's been making waves not just in India but around the globe, which is UPI expanding to other countries. We'll walk you through what this expansion means for us. And then we will discuss the Red Sea crisis, which is leaving its mark on India's trade and economy, and discuss the implications on sectors. In the last segment, we'll break down the recent news about EPFO fixing the interest rate on employees' provident fund at a 3-year high of 8.25%, and we will also compare the return with other tax-saving instruments. Let's begin. You're watching Informed Investor, initiated by ResearchAndRanking. Not long ago, the world faced a significant challenge with high inflation. We witnessed inflation reaching a 40-year high in the United States, while India also experienced a notable inflation rate above 7%. Now, you might wonder why inflation is such a big deal. Well, typically, a moderate level of inflation can actually be beneficial for an economy. It indicates growth and can stimulate spending. However, when inflation levels surge too high, it can be damaging on people's lives and on a country's economy. Think of it this way. When the price of goods and services skyrocket, everyone feels the squeeze on their wallets. You've probably noticed this yourself when you see your grocery or rent or other utility bills climb higher and higher. But while costs are going up, it also doesn't necessarily mean that our salaries are rising at the same pace. This means that households end up facing tough times as their purchasing power declines in the face of high prices. Now, to tackle inflation, central banks often resort to increasing interest rates. Now, this move is aimed at making borrowing more expensive for both businesses and individuals. Now, what does this mean in practical terms? Well, higher interest rates can discourage businesses from taking out loans to invest in new projects or expand their operations. Now, this in turn can put a damper on economic growth as businesses become hesitant to spend due to the increased cost of borrowing. Moreover, high inflation interest rates also have a knock-on effect on companies' valuation. When interest rates climb, the cost of borrowing rises, which impacts a company's future cash flow projections and its overall value. Now, to bring inflation down in the US, the Fed hiked interest rates at an unprecedented rate. Now, this move had a twofold impact. It strengthened the US dollar, attracting the capital inflows to the country, but it also had adverse effects on emerging economies worldwide, such as India. As the value of their currency drops in comparison to the dollar, these countries faced even higher domestic prices, especially for imported goods priced in US dollars. Now, this impact was felt in India. So we can see how high inflation can be a massive problem for us. Now, back at home, to tackle the surging inflation, the Reserve Bank of India have swiftly acted by hiking interest rates. Now, after India witnessed its inflation rate hitting a 4-month peak of 5.7% in December, there's been a noticeable turnaround. In January 2024, inflation dropped to 5.1%, marking the lowest level in the past 3 months. Now, this decline was pretty much as expected thanks to some favorable factors like a base effect and gradual easing, particularly in the food sector. Notably, inflation in food and beverages eased from 8.7% in December to 7.6% in January. However, certain items like spices and pulses still maintain double-digit inflation rates. Now, the RBI has this clear mandate to keep CPI inflation of a target of 4% with a margin of plus or minus 2%. Now, despite the recent drop, inflation is still above the ideal target of 4%. However, it's worth noting that it has stayed within the RBI's upper tolerance band of 6% for the past 5 months. But what's really noteworthy is the core inflation, which essentially excludes volatile items like food and energy, which also saw a decrease. It went down from 3.9% in December to 3.6% in January, staying below the crucial 4% mark for 2 consecutive months. Now, this hints at some stability in inflationary pressures beyond the volatility in food and energy prices. Now, do know that controlling inflation is no easy task, given a significant proportion of India's inflation coming from the food sector. And that's where things get complicated, because these factors driving up food prices can sometimes be beyond the control of central banks. Now, in its latest move, the RBI opted to keep policy rates unchanged, indicating that any potential interest rate cuts might be delayed. Moreover, the central bank has also expressed caution regarding the inflationary outlook. So while there's some relief in the moderation of inflation, the RBI remains firm in its commitment to maintaining price stability, suggesting that any adjustments to monetary policy will be made with careful consideration and a keen eye on inflationary pressures. Now, clarity on whether what is happening next will only come in later quarters. Imagine you're hosting a competition where you want to showcase the best performers from different countries. You create a special leaderboard to keep track of the top contenders. Each country gets represented by its best athletes and their performance in various events gets recorded. Well, think of the MSCI Index as something similar but for the stock market. It's like a giant scoreboard that tells us how well different countries' stock markets are performing. The MSCI Index, short for Morgan Stanley Capital International Index, is like the ultimate benchmark for global stock markets. It's widely recognized and used by investors worldwide to get a quick snapshot of how stocks are doing in different parts of the world. Now, we have our own section in this global scoreboard called the MSCI India Index. This section is super important for both domestic and international investors. Now, for people outside India, the MSCI India Index is like their window into our stock market. It helps them understand how the Indian market is doing compared to the others, which is crucial when they're deciding where to put their money. It's kind of like a report card for Indian stocks that international investors use to make smart investment choices. Now, the MSCI India Index isn't just for show. It actually plays a big role in attracting foreign investors to a market. When a company or a bunch of companies from India get added to this index, it's like they're getting a stamp of approval. Investors from around the world take notice and then often rush to buy these Indian stocks, which can drive their prices up. On the flip side, if a company gets kicked out of the MSCI India Index, it can spook investors. They might start selling those stocks, causing their prices to drop. So in a nutshell, the MSCI Index is like a report card for the global stock market, and the MSCI India Index is our own special section in that report card. Now, it's a big deal for investors, both local and international, and any changes in its composition can have an impact on our stock market. In a recent development, India's weightage on the MSCI Global Standard Index has hit a record high, reaching 18.2% in the latest February review by MSCI. Now, this increase marks a significant, nearly double rise since 2022. Now, India currently ranks second in terms of weightage on the MSCI Global Standard Index, just behind China. In the February review, MSCI added 5 Indian stocks to its index without removing any, a move that underscores the growing confidence in India's market. It has included 5 Indian stocks, BHEL, Punjab National Bank, NMDC, Union Bank and GMR Airports into its portfolio and increased the weights of 12 existing stocks. Now, according to estimates by Novama, this adjustment is likely to result in a passive fund flows of more than $1.2 billion from overseas investors. Conversely, the index provider removed 66 Chinese stocks while adding 5 new ones. Meanwhile, China's weight in the index has also declined to 25.4% now. Now, the exclusion and decline reflects the challenges facing China's market. The ongoing concerns about China's struggling property sector, weak consumption have impacted investor confidence, leading to a decline in China's weightage in global portfolios. Now, the gap in weightage between India and Chinese equities on the MSCI Index will also be the shortest ever, and analysts expect this gap to narrow down further. So what does this mean for us? Well, it's a sign that India's stock market is gaining more and more importance on the global stage. Investors are likely to pay even closer attention to Indian stock now, which could mean more investments flowing into our markets. UPI, which was introduced 7 years ago, has not only changed the country's digital payment scene, but also has won international acclaim. And guess what? Payments through India's UPI will now be accepted in 7 countries after its recent launch in Sri Lanka and Mauritius. The other countries in the list are France, UAE, Singapore, Bhutan and Nepal. And that's not it. National Payment Corporation of India has also signed an agreement to enable QR-based UPI payments in 10 Southeast Asia countries. These include Malaysia, Thailand, Philippines, Vietnam, Singapore, etc. Now, the government is also working to bring UPI service support in the United Kingdom, Australia, European nation and the US, among others. Now, UPI is expanding globally to make international transactions faster and cheaper. It aims to create a network for quick, low-cost, cross-border transactions and promote India's digital finance system in countries where there are strong trade and travel links. Now, although progress is happening, it will still take time to see the full benefits of these efforts. Nevertheless, India has been proactive in extending the reach of UPI globally and also growing remarkably within the borders. Now, just to put a few facts in before you. UPI payments in the country have been hitting record highs, with the latest reading in January 2024 amassing a massive 18.41 lakh crore worth of transactions. Similarly, the number of banks involved in the UPI transactions also hit a record high of 550 banks. In just a year, 165 banks have joined the payment process. In conclusion, India has emerged as one of the fastest growing ecosystems for fintech innovation. The journey of UPI has indeed been a remarkable one, and now even taking it across borders with other countries jumping on board. let's delve into how the Red Sea crisis is significantly impacting India. Now, the root cause of this crisis stems from the attacks by Houthi rebels on cargo ships and tankers, leading to a situation where numerous vessels are now avoiding the Suez Canal, which is a crucial waterway for global trade. Now, this avoidance has forced ships to take the alternative route around the Cape of Good Hope in southern Africa, which adds over 3,500 nautical miles and almost 2 weeks of additional sailing time to each journey, and this longer route is substantially driving up shipping costs. Now, but why does this matter to India so much? Now, India heavily relies on this Red Sea route via the Suez Canal for its trade connections with key regions like Europe, North America, North Africa, and the Middle East. In fact, according to CRISIL ratings, around 50% of India's exports and about 30% of its imports in the fiscal year ending March 2023 were tied to these regions. Now, let's talk about the real-world impacts. Now, companies that heavily depend on exporting their goods are facing shipment delays and a notable surge in shipping costs. For instance, just before the crisis hit in November 2023, shipping rates from India to Europe and the US ports typically ranged between $500 to $1,000 per 20 feet container. Now, there has been a staggering increase in shipping rates from India to Europe and the US, soaring nearly fivefold. Now, the reason behind this increased cost is simple. Shipping companies have to change their routes due to the Red Sea crisis. Now, ships have to take the longer Cape of Good Hope route, which means more time at sea and higher fuel costs. As a result, shipping expenses are going up. On the back of this, India's exports are taking a hit because of this crisis. For example, India's exports of petroleum products to Europe dropped a lot in January 2024, hitting an 18-month low. Now, according to CRISIL analysis, companies operating in sectors such as agriculture commodities and marine foods are particularly vulnerable due to the perishable nature of their goods. On the other hand, sectors like textiles, chemicals, and capital goods may not feel the immediate pinch thanks to their ability to pass on higher costs. However, should the crisis persist over the next few quarters, even these sectors could become vulnerable. In contrast, industries such as pharmaceuticals, metals, and fertilizers are expected to weather the storm relatively well. Companies in these sectors enjoy healthy profitability and are better positioned to absorb the higher freight costs associated with the crisis. Now, despite varying sectoral impacts, most industry insiders maintain that the crisis may not be a long-term issue. Nevertheless, the current situation remains extremely volatile, with experts warning of potential adverse effects on India's economic growth. Fitch Rating has also expressed concern, suggesting that if disruptions in the Red Sea persist, significant downward revisions to India's growth forecast are likely. Employee Provident Fund is a conventional method of saving money, especially for retirement, that many of us rely on. It's widely trusted as a solid avenue for retirement planning, offering the added benefits of tax savings at 3 different stages: when you contribute, when interest accrues, and when you make withdrawals. Now, despite its popularity as a retirement savings tool among Indians, many of us aren't fully aware of how our EPF contributions are invested. Surprisingly, the Employees Provident Fund organization doesn't just stick to traditional debt investments. They also venture into equities. Now, most of the funds are usually channeled into debt instruments like government securities. However, in a significant move back in 2015, the EPFO was granted permission to include equities in its investment portfolio, but within certain limits. Initially, they could allocate only up to 5% of the corpus to equities, but this limit was gradually increased to 15% by 2017. Now, in terms of recent updates, the Central Board of Trustees of the EPFO has decided to bump up the interest rates on EPF for the fiscal year 24 to 8.25%, up from 8.15% previously. Now, once this decision receives approval from the Finance Ministry, it will directly benefit over 6 crore EPF subscribers who will see the increased interest reflected in their accounts. It's also interesting to note that just in March 2022, the EPFO had actually reduced the interest rates on EPF for the fiscal year 22 to 8.1%, marking the lowest rate since fiscal year 78. However, when comparing EPF returns to other small savings schemes like PPF, Sukanya Samriddhi Yojana, and post office deposits, which offer up to 8.2% annually, the recent increase in EPF interest rates makes it a relatively more attractive option for those seeking stable returns with tax benefits. Having said that, this is me, msciindex, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.